Hello everyone, welcome back to Financial Options with Thumper. And today I'm very excited to get this video out. I've been planning this for a couple of weeks, trying to put in as much information as I can. This video is going to be teaching beginners how to sell options, which is not what you normally see when you are searching options. Typically, beginner videos are set up for buying premium, whereas I like to sell premium, get those small wins, and they just add up over time. If you truly are a beginner to options, I'll tell you, I'm actually a bit jealous of you because that's an exciting time. All that learning you're gonna be learning is pretty cool. It took me months to learn all this stuff, and then on top of that, I now have years of experience. And you're getting all that knowledge in one short video here if you end up making it through the entire thing. So that's pretty cool. I'm going to start off by saying I'm not a financial advisor. I mean, obviously this video is for entertainment purposes and shows what my understanding of options are. Before you start making financial decisions, do your own due diligence, your own research, contact your financial advisor, because don't trust some stranger on the internet, you know? So first off, in order to learn how to sell options, you gotta understand what an option is. You're not selling something that's a stock. You're selling contracts, and a contract is basically just a promise for the seller to perform an action in the future if the buyer wants you to. And that's basically all it is. A contract is just a promise if certain conditions happen. In most cases, an options contract represents 100 shares. I have not seen a contract that uses a different amount, but I guess in the past that was common. I've yet to actually see it be different, but typically a contract is 100 shares, and you can check that in the options chain before you sell it. I think something that confuses people is they don't understand how they can sell something that they don't actually own. So if you think of the contract as a promise, you're selling a promise is what you're doing. So this is why you can sell stuff while you don't actually own something. So to understand what a contract is, you gotta be able to read how it's described and understand what each piece means. And there's basically 5 parts to it. Over on the left here, this is what you might see a contract look like when you're looking at it. On the right is the price. And I'm going to break it down by each section right now. So first off, you typically see the symbol of the stock or index that you're selling the contract on. This is the underlying that you'll be performing some action on. Whether you're buying 100 shares or selling 100 shares, that's the stock that it has to be on. Over here, you're seeing a number, and this is the strike price. And this is the price that you perform the action at. Just keep that in your mind. So strike price, what price I'll be doing some action on the stock that I sold this contract on. Obviously, this is a date. This is the date that this contract expires, or when your promise to perform that action is no longer in play. So once this date passes, this contract is worth nothing. You've either performed the action that you need to, or it's become worthless. The price, this is also the premium that you receive when you sell it. So you see it marked as $3.50, but remember, there's 100 shares in a contract. So in this example, you'd be making $350 if you sold this contract. And this is cash that you receive for making that promise. You keep this cash no matter what happens. Whether you have to buy the stock or not, you keep that. That's money in your pocket. You can go and buy lunch today with it. And the last part is you either see a put or a call here. It's just a type of contract. You might see it as P or C, or your broker might put in put or call. It's the action that you promise to make on this stock on this date for this price. There's really your 5 pieces. And now I'm going to go into what's the difference between calls and puts. And I like to think of it as it's 2 games being played basically on the same board. When you're in middle school and you're playing checkers with one friend, they might have the rule where your piece can do backward jumps on double and triple jumps. And then you verse another friend, and he says, no, those pieces can't go back in double or triple jumps. That's basically what this is. Like, you choose which of these games you are going to play, or which variation of rules you're going to be playing on. It all happens on the NASDAQ, so like the board is the same. And you can choose if you're the seller or the buyer. Like, do you go first or not? You choose which side, which variation of the game you want to play. If you're liking this content, please take a moment to like, share, subscribe. It really does help a small YouTube channel grow. Going into puts, with a put, you're agreeing to buy 100 shares at the strike price you chose, and for this promise, you get paid that premium. You lose if the stock goes down past the strike price and past your break-even point, and this is because you'll be buying a stock at a higher price than it's worth. An example I have here is Thumper. Say you sold the 69 put and the stock went down to $60. The buyer is going to exercise that contract, and he's going to sell you 100 shares at $69. And you lose here because you can only turn around and sell those shares for $60 each, and that'd be a $900 loss, minus whatever premium you got when you made this promise. Worst case for puts, if you're selling puts only on stocks that you would want to own, the worst case scenario is that you got paid to buy the stock at a discount. Like, that's pretty cool. If you're going to buy 100 shares of a stock, use a put to get into that position, and you'll make more money just getting into the position. If you're selling puts on stocks that you don't want to own, that's where like the worst case is actually worse. But so that's why I suggest that when you're starting out, only sell puts on stocks you want to own. Some people will sell puts above the current strike price to enter a new position. This would be called selling a put in the money. An example of this would be Thump stock is at $65, and you sell the 69, where you get $650 for premium. If Thump stock stays below your strike price, you're going to have to buy 100 shares at that price. So instead of buying at 65, you're buying it at $69 a share. But because you received $650 in premium, your cost basis would actually be $62.50 instead of $65. So you can use puts to enter positions at a discount. Again, really cool idea. If for some reason in this example the stock price went up to 70 or above 69, then all you did is you made $650 for doing nothing. Puts, you have defined risk and reward, defined profit. You can't make more money than the premium you received when you sold the contract. You give up potential profit for money now that you can go and spend immediately. Or you can take that money and go buy more stock with it, create more leverage. Some people call this undefined loss. I consider it defined. The most you can lose is if the stock goes down to 0, and you lose whatever the strike price is you sold it at times 100 minus whatever premium you received. So if you sold the put at 70 and the stock went bankrupt, you just lost $7,000 minus whatever premium you received. Now, even though that's the max loss, think about what your PROB loss is. If you're selling a put on Apple at 120, what are the chances that Apple is going to go down to 0 and make you lose $12,000? I don't think that's going to happen anytime soon. Maybe Apple might shoot down to 100, which would be crazy, but I mean, it could happen. That would only be like a $2,000 loss. So max loss is not the probable loss that you will have when you're selling contracts. Buying puts, think about the opposite end. Knowing how they work will help you choose when to enter positions. Some people might be buying puts in order to hedge their positions. If they own 100 shares of a stock and earnings are coming up and they're worried that the stock might tank, they might buy a put so they can sell their shares to you at a price in the event that it tanks. Other people might be using it as like a lottery ticket kind of thing. Their max loss is the debit they paid you to make up the contract. And their max win is if the stock goes bankrupt, goes down to 0, because that contract price is going to increase. So it's unlimited profit potential and limited risk. So that's the opposite side of them buying. Now, next up are calls. Different variation of the game. most of the same rules apply, except instead of agreeing to buy shares at a certain price, you're now agreeing to sell 100 shares at that strike price. And for making this promise, you're getting paid a premium that stays in your pocket no matter what. You lose if the stock price goes up past your strike price, because you'd be selling a stock at a lower price than it's worth. In this example, say you sold the 69 call and the stock went to 72. You're selling 100 shares at 69 to fulfill the contract instead of selling them for 72, which you could do at the market. There's a $300 loss minus the premium received. But if you received $400 from premium, this could still be a profitable trade for you. If you own stock and those shares are getting called away, that's called a covered call, your loss is the potential gain that you missed out on. Because you already own the shares, you're not having to buy new shares. Those are just being sold at 69. You miss out on that extra $300 profit from the difference between 69 to 72. If you don't own the stock and you're using you still have to sell 100 shares at 69, but to get those shares, you have to go into the market and buy those at 72 to sell at 69, and that's where you get your $300 loss. So either way, you get the same loss whether you have the shares or not, but you run a little bit more risk if you don't actually own the shares if the price keeps going up, because technically it could go up to infinity. So calls, if you only sell calls on stocks you already own, then you're selling what is called a covered call. And what happens is, if your contract gets exercised, your 100 shares will disappear from your account, and you receive the cash for whatever strike price you sold it at. Really, what you're doing, assuming you're selling above your cost basis, is you're agreeing to sell your shares at a profit, and you're getting paid for that. If it doesn't get breached, then you just get to keep that premium no matter what. If it does get breached, well, you already said you're okay selling your shares at that point, and you still got that premium. Like it just enhances your returns. So like selling cover calls, I think everyone should be using it. The only downside would be if you have tax concerns, I think. So calls, if you only sell calls on stocks you already own, then you're selling what's called a covered call. And if, assuming that you're doing this above your cost basis, you are agreeing to sell your shares at a profit, and you're getting paid a premium to do that. Make it even more money. Think about that. How cool is that? Like, really, it's pretty cool. If the strike price that you sold your covered call at does not get hit, you still keep your 100 shares, you still keep that premium that you received, and you can turn around and sell another covered call. And you can continue doing that until your shares get called away. And some people use this as a method to exit a long position, and they'll sell calls below the current strike price in order to get out. An example here would be if I sold a covered call at 63 on a stock that's sitting at 65, the premium I received should be pretty good because I'm selling an in-the-money call. If Thump stock stays above 63, I sell my 100 shares at 63. But you also get to keep that premium from selling that contract. Now, had I sold my shares at 65, I would have got $6,500. But by using a call to exit the position, because of that premium, even though I'm selling at 63, I come out ahead because of the premium I received. There's another way to make a little extra money from positions you're going to exit anyway. It's really powerful things here. Again, how's the opposite side play in this game? Well, they might be doing it to minimize max loss. So they might be very bullish on a position, and they don't want to put up the money to secure 100 shares to try to get that bet to work. Instead, they put up a fraction. That's just the premium that they give you to open up this contract. That's their max loss, and they still get to enjoy the gains if the stock does go up the way that they suspect it to. And some of them might be using it as lottery tickets because of like the stuff I just said. Like their max loss is the debit they pay to you. Their max win is infinite because the stock might go up by a lot, or dare I say the moon. Wall Street bets reference. Here's a little quick overview. This is like a picture of something that I used to have on my wall when I was first learning about calls and puts. And this will let you kind of see what happens depending on what side of the contract and which version of the game, call or puts, that you're playing. So long just means you own the right, or you own the shares, or you own the contract. Short means you sold the right, sold the shares, or you might be short stock. So I'm mostly always short, so I'm the seller of the options contract. I'm the one that has to fulfill the contract if exercised. On the other hand, the buyer is the one that chooses if the contract gets exercised. So that's the difference between long and short here, if you're the buyer or the seller. For calls, short call, I'm the one obligated to sell this underlying at that strike price. It's a bearish position. And you don't know what bullish and bearish mean. Bearish means you expect the stock to go down. Bullish means you expect it to go up. And obviously the opposite of it, they're bullish when they buy a long call, and they're buying the right to buy the underlying at that strike price. Puts, the short seller, or us, or me, obviously, I'm obligated to buy the underlying at that strike price. It's a bullish position because I want the stock price to go up and not breach my strike price. On the opposite side, the long position, they want the price to go down, so it's a bearish position, and they have the right to sell the underlying at that strike price. Other terms that you should know by now would be in the money. This is the price of the stock. The price of the stock is at a point where the buyer will make money exercising the contract. For a put, if the price is lower than the strike price, it's in the money. For a call, if the price is above the strike price, it's in the money. And then out of the money is the opposite. This is where we want to live. It's when the price is at a point where the buyer loses. So for a put, the price is higher, so we don't have to buy the shares at the lower price. And then for the call, it's lower, so we don't have to sell the shares. Some other terms, and if you're talking about these in Discords, like, be sure to use them. It tells other traders exactly what you're doing so they can help you. Sell to open means you sold a contract to open the position. That's what you're doing. You're selling premium. The opposite is you're buying to open. You're buying the contract to open the contract. Selling to close would be the opposite of buying to open. They're selling it to close the position. And buying to close is when you're buying the contract back in order to get out of your obligation to fulfill that contract. If you just put in your trade that you bought a contract, they don't know if you're buying to open or if you're buying to close that position. So be sure to include that when you're talking about it. Or if you see other people put those in, now you know what those mean. And for me, options is a seller game. Have you ever heard that saying 90% of options expire worthless? Someone's trying to pitch you like their course or something. They love using this line, 90% expire worthless. Come do it and win 90% of the time. That's not really how that works. The Chicago Board Options Exchange has statistics. 10% of contracts, only 10% of contracts are actually exercised, but typically 55 to 60% are closed out before that. And you don't know if those 55 to 60% the seller is winning or losing. Although they do also say that 30 to 35% expire worthless, meaning the seller kept the entire premium when they opened the contract. So the benefit is in the seller's favor based on these statistics, but don't think it's 90% to 10%. Like, it's more like 10 to 30%. Still, I'd rather be in that 30% than the 10%. And that's why I'm selling options and not buying them. Some other things you can do is you don't have to wait until that day of expiration for this contract to play out. You can choose to exit the contract at any time. The way I like to think of it is if you gain an early lead, you can say, I win, and close the position down, give them back a small portion of whatever they paid you, walk away with your little profit. It's just like a little kid saying, I win early, even though it's not done. That's the way I like to see it. It's just fun to think of it that way. At any time, you can declare the victor and walk away from the position. And the opposite side, you don't have to sit there and wait out losing positions. If you made a mistake or new information that has come and changed your trading thesis, you can close it out, avoid additional risk of it running against you, you losing more money to that position. Just take the loss, move out. You might be able to close it for a small profit depending on the scenario. Some examples of this is there's been times where I've clicked the wrong button and I've did the opposite trade that I wanted to do. Like instead of selling open position, I bought open position, and immediately after I turned around and closed that position. And actually, one time I gained like $20 from it. Another time I lost $40, and this is within like 30 seconds of opening the contract. So if you make a mistake or you are not confident about a trade, you can exit it and just get out of that position. You don't have to hold it and try to diamond hand it and make it a win position. Just get out of it. Another thing I love about contracts or option contracts is that you can roll it. And I see it as like saying redo and again. If you're losing your game, like the price is moving towards your stock price, or at expiration you're in the money, what you can do is buy to close your current contract and then go out further in time, maybe 2 weeks, a month. You can sell the same strike or potentially get a better price or a better strike price. And usually you can do this for a credit. So going back to my example of it being a board game, say you bet your friend, you give me $50. If you beat me 5 times in a row, I'll give you 75. And they go on, they win the first 3 games. You're like, you know what? You might actually win this. How about I give you $10 now? We'll call you the winner. But now, let's do it again. Except this time you give me $100, and I'll give you 150 if you win 5 times in a row. Like, just keep doing that, and kind of imagine like a little kid flipping the table saying, "This game's bad. Let's start over." And you can continually doing that theoretically. Reasons to sell options. It's appropriate for most market conditions. If the market's going up, I could sell puts and make money. If the market's going down, I could sell calls and make money. If it's trading flat, both calls and puts will be making money. So you can make money using options in any market condition. You have a high level of control via exit strategies. If you haven't seen my managing options gone wrong video, I recommend going and see that. Like there's many things you can do to minimize risk and turn losing trades into winning trades. It's instant cash in your pocket that you can use. You can take it out and go buy lunch with it. You can use it to buy stocks with it. You don't have to wait for the 30 days. You can use it for downside protection. If you're selling covered calls, if the stock goes down, you're still lowering your break even. So that's something that's really cool. You can sell covered calls on stocks and still capture the dividends while collecting that premium for selling the covered call. So you still get dividends while you're selling these. These work in IRAs, which is pretty cool. You can be wrong and still make money. I'm going to come back to that in a second. And what's also neat is you can turn any stock into an income stock that pays whenever you want it to. With AT&T, you'd have to wait 3 months to get a $50 dividend if they don't lower their dividend. Yeah, I went there. Instead, though, you can sell a monthly contract, sell a contract a month out, collect maybe $40 a month. By the time a dividend investor gets their $120, by the time the dividend investor gets their $52 for holding it for 3 months, you might have collected $126 in that time. And if you're doing this as covered calls, you collect that $126 in addition to the dividend that it pays out. It's just really good for that. Using the same principles, like I play Netflix a lot. I'll sell a monthly contract on Netflix. I get that income from Netflix. Not a dividend stock, but here I am making monthly income from Netflix. I mentioned that you can be wrong and still make money. Well, I'm going to go into why that happens. And when I'm looking at this, I see it as, I'm a king and I'm sending out my armies to go do battle against the buyer. And I have 3 really well-trained knights that are out there that the buyer has to beat in order to win this contract. And 2 of them are Theta and Vega. And the third one, I guess I'm just going to call it Direction. There might actually be a real name for it, but we're going to what all 3 of these guys do. So first off, we got my favorite white knight, the Theta. And this is time decay. Basically, this is how fast an options contract is losing value each day while it marches to the real value at expiration. As you get near the end of the contract, theta increases. I tend to think of this as your night's getting experience, and you slicing away at that contract price more heavily as time progresses. Like, this is one that I don't want to be on the wrong side of, so this is why I'm always selling premium. As I mentioned, as theta gets near, as the options contract gets near expiration, theta increases. So a contract that has 120 days, in 30 days, the option value, like, it doesn't lose much due to theta. The next 30 days, it loses a little bit more, but still not really that much. You can see as it gets closer, that difference in how much is lost over 30 days gets bigger. In the final 30 days, like, look how much that option contract loses. Like, it gets pretty quick, especially the last 14 days. Huge gap compared to 30 to 15. This is why, this is one of the main reasons why I think selling options is very successful, is you have theta chipping away. You're just betting that the chart is going to go to the right. You don't care if it goes up or down. Yeah. Volatility. Typically, implied volatility is higher than realized volatility. So if volatility decreases over time, the price of the contract goes down. This can get you some wins earlier than having to wait for expiration. A good example of this would be if a contract goes through a stock's earnings, you'll see increased premium because volatility or implied volatility is higher for that contract until the earnings date. Once earnings happens and everyone knows what happens with the stock during that earnings, volatility decreases because, well, we know what just happened. You can sell contracts in a high IV environment, and then once IV contracts, that contract could be worth a fraction of what it was. You can turn around and close that contract right there. It's also called IV crush. You'll see people that buy premium say, learn about IV crush and how to avoid it, because this is one that can make you an instant winner. So Vega, another night that we have out there working in our favor. And I like to call this one direction. You always hear you can't time the market, you can't time when something's going to go up, or you can't time the dips perfectly. But when you're buying option contracts, that tends to be what you're trying to do. When you're selling contracts, well, let me just show this example here. So this is a contract on Netflix. At the time that I took this screenshot, Netflix was trading at 500, so here's what the price is. This blue line is your net profit at expiration, depending on where the price is at expiration. So here at 500, if the stock goes up, you can see I always make that 228. If the stock stays flat or stays in this little area, I still make my 228 bucks. If the stock goes down, which was not my intent, I still make money up until that 450 point, even a little after that because of the premium I received. This is why I say, like, direction, it's playing in my favor. The buyer has to beat all three of these nights in order to come out with a profit. I just need one of these guys to succeed, and I'm probably walking away with a profit. The buyer has to say what stock or what price the stock price could be above or below in a short, specific time frame, and hope it gets there quickly. Whereas we don't have to worry about that. As time passes, we're just watching that contract go down in value unless the buyer has all three of those things correct. So what are my goals when selling options? I think of it as I'm trying to sell the buyer something that I think is going to be worthless. Like, here's a bag of air. Give me $100. Here's a bag of air. But you know what? I'm going to keep the bag even. Like, here's some air. Like, you're selling them something that you hope is completely worthless. And if it's not, you can go back and use some strategies to manage that trade. Other ways that I use selling contracts or selling options is I'm using it to get paid to wait for a discount to enter a position, and also making some money getting paid to lock in a profit, because I'll sell cover calls above my cost basis, and eventually it'll breach and I can get out of that position with a profit. When you do start opening an account for options and applying for it, most brokerages have option levels that you have to apply for. I don't think I've ever heard of anyone getting denied level 1 and level 2. And you can get level 3 and level 4 later when you get more experience with that broker. So level 1 is typically what you need in order to sell the options. Covered calls, that's when you own 100 shares and you're promising to sell those shares at a strike price. Hopefully you're selling that above your cost basis, so it's for a profit. Cash secured puts would mean that you have the cash in your account to buy 100 shares at that stock price. And what the broker would do if you're only level 1 is partition that cash off to the side, kind of, to secure that position. Level 2 is for buying premium. Like, I don't buy premium except if I'm doing poor man cover calls, so it doesn't really matter. But when you're applying, you might as well apply for at least level 2. So level 3 options are spreads. Spreads are really cool. They're a great tool for smaller accounts, but they're also a bit more risky. If something goes against you, it's more likely to wipe out your account. Whereas if you're just selling cash secured calls and puts, you can manage those trades a little bit easier. And then level 4 is when you start selling naked options. That's when you don't have the cash in the account to secure the position, and you're hoping that you're right. Otherwise, you have to deposit money to take assignment of those positions. Different brokerages have different definitions for levels. This is Fidelity. They have 5 levels. Like these option levels, I do like that brokerages do these option levels. Like they mostly do it to like protect themselves. But if you stick to like a level 1 option level or a level 2, they won't let you put yourself in a position where you're gonna blow up your account pretty quickly. So like it's a nice little safety net to be at level 1 and level 2 when you're starting to learn how to do options. Once you get more experience, you can move on to the other ones to enable more riskier plays that might have higher profits. But starting out, being at level 1, level 2, I think is actually a good thing. So I'm glad that brokerages actually do that. Another thing you're gonna have to learn about is how to read an options chain. This is actually the ThinkOrSwim options chain. Like when you go in for the first time, it's like this is the default view. They show both the call and put contracts at the same time, and I really like this setup so you can see how both sides play at the same time. Since the dates are the same, that's only showing up one time, and the strike price, same thing. You can sell a $480 call that's in the money, or a $480 put that's out of the money for that date. Like it's just a really nice layout to look at. Most of the time, you see what the bid and ask is. Hopefully, the last is in there. ThinkOrSwim includes the extrinsic value. That's really neat, but you don't have to worry about that for now. One side you see is kind of colored in blue. Other brokerages, it'll be a light gray. These are options that are in money, meaning the buyer has a benefit if they choose to exercise that contract, and the seller will have to perform that action. As a seller, you want it to be out of the money, so typically you want it to be outside of the money. You have the option to change how this looks to suit your needs. I like to look at one side at a time, so I'll choose to just look at the put side, and I put in a couple of different columns in here: Theta, Delta, probability out of the money. Probability out of the money, I think, is really useful. When I was first starting out, I relied on that quite a bit. Some tasty work videos, they say that the most probable trades are the ones that are traded at 70%. I think that's actually kind of risky, even though I'll admit I was playing at 70% quite a bit. I'm actually moving up to like 85%. When you start doing this, you'll learn where your risk tolerance is and how far out of the money you should be going. And something just to note is the closer to at the money that you are, the more premium you receive. So if stock is at $492, if I sold the $490 put, I'd make $1,100, almost $1,200, depending on the fill. Whereas if I move to a safer strike, that's more likely to be out of the money, like at the 415, I'll just make $100. And that's because you're selling and buying risk is what option contracts are. By selling a contract here, it's more risky to me because it's more likely that it's going to be in the money. So I'm getting a higher premium for taking on that risk. Whereas if I'm selling up here, is less likely, like 5% chance just about. And so I get paid less because I'm taking on less risk at this point. All right, so now I want to show you how to sell a put on interactive brokers. And then after this, I'm going to show you how to sell a call on the ThinkOrSwim platform. I think you can use whatever brokerage or platform you're comfortable with. They all should work about the same. I personally like interactive brokers the best for managing my account, although I do all my research in the ThinkOrSwim platform because I'm more comfortable with that than looking at the charts and stuff. So anyway, going into this, I'm going to be selling a put on AT&T. So I use that as an example in my video already. So I bring up the AT&T options chains by clicking on position. And I typically look for 30 days out, maybe 45. So let's jump out there a little bit. And I think I might want to stay around the 27.50 mark. And actually that looks like a pretty good premium for that. So that's, if I sold this contract, I should make about $44 for selling the promise to buy 100 shares at this price. Another thing I like to do on interactive brokers is turn on the strategy builder, and it'll let you see the margin impact pretty quickly. But let's take a look at July 30 real quick. 27.50. So waiting an extra week only gets me like $3 extra. So I think I am gonna go with July 23rd. So what I'm going to do here is on the options chain, on the bid column, I'm going to click on it and click sell. I kind of like this place. I'm going to put on 2 contracts. I like to just see if I can get the mid or better. In this case, we'll try 44. And over here, I can see my margin impact. I made a margin video if you want to learn how margin works. I'm going to click submit order. I just look over this real quick. The amount here, I'm receiving $88 for selling these 2 contracts. You can see my margin goes up as a result, which makes perfect sense. I'm going to transmit this, and now we see if we can get filled. So far, it looks like I'm not, although I own the ask. I could sit here and wait to see if it gets filled. It probably will get filled at some point, but for this video, let's just walk it down a bit. Do we get filled at 43? No, really? Come on. All right, we'll walk it down. I'll take the bid just for this video.
Partially filled. Order filled.
And you can see that's $84 that just hit my account. So that's pretty cool. All right, and I'm going to show you how to sell a call on the ThinkOrSwim platform. I'm actually doing this in a virtual account because I'm not wanting to sell a naked call in my IRA. I can't do that. I would buy 100 shares first before I could do that. So this is a virtual account I'm going to do this trade on. And similar thing, you go through, find the date you want to work on. Let's go July 16. Oop, I want to make sure I'm doing my call, so switch this to calls. And I might be looking at a little bit more out of the money. Doesn't look like there's much premium here, so this would not be a trade I would actually do in real life here, unless it's a covered call. And I'd be fine with selling at 31. But I would not be selling naked calls at this level. But anyway, all I do from here is I click sell. Make sure that this is the amount you want to do. ThinkOrSwim starts with a default of -10. You don't want to be selling 10 contracts by accident, so make sure you check that. Change the price to whatever you want. I'm going to lower it to get a quick fill here. Confirm and send. You can see I just made $12 by selling that call. Now I just have to wait 36 days to see if it expires, or at some point, if the stock moves up in my favor, or down in my favor, then I can buy back to close and exit this position for a small profit. All right. So now you've seen that. You've heard me talk about expiration quite a bit. Any options that are in the money are automatically exercised at market close that day. So that's something to be aware of. Like, the buyer doesn't have to go in and say, I want to do it. The broker will automatically do it, because at that point, it's in the buyer's favor to exercise that contract. Something to know is that even contracts that are out of the money at that point can still be exercised if the buyer informs the brokers up to an hour and a half after close that day. That's something called pin risk. If you watch one of my videos, I made one about pin risk. Just know that options can be exercised an hour and a half after close on that expiration date. Just something to be aware of. Any assigned positions are typically processed overnight, so you'll see the change in your account hopefully by Saturday morning. You check with your brokers to see how fast it goes through. Some ideas for like first-time traders: try using a paper account to learn the mechanics of options. Go in there, sell some in-the-money calls and puts, and see how those get exercised, how the account behaves when that happens. Using ThinkOrSwim, you can go back in time using the on-demand feature and gain like a year of experience in a Saturday night, just sitting there, put in your contracts, fast forwarding time to see how those go. Like, you can gain a lot of knowledge quickly by using the on-demand features in ThinkOrSwim. And when I say learn the mechanics, like that's truly what I want you to learn when you're using like a paper account, is the mechanics of the trade, how they behave, how you manage those trades. Like, you won't really learn the risk profile until you have skin in the game. And when you do decide to start selling options for real, I would highly recommend using covered positions to start out. Use covered calls, buy 100 shares of the stock, and then sell a covered call against the position. If you're a dividend investor, maybe you rebalance your portfolio so that you can get a couple positions that have 100 shares to experiment with this. Use cash secured puts. Make sure you have the cash in the account at the strike price that you're going to be selling that you could take assignment of the stock if it gets breached. Research the wheel. One of my videos, I talk about the wheel. I'll talk about that briefly after this slide. The wheel is a great strategy for beginners to use because you learn all the mechanics of calls and puts. And I think it's a pretty low risk proposition, assuming you're playing on a stock that you would not mind owning. That's very key to learning the wheel. And when you do end up getting in the game, maybe try a stock or two that are lower in price than you would normally play. When I started, Ford was trading around $5 a share, so I was selling put and call contracts against it to see how that worked. A brief overview of the wheel. You can take a screenshot of this if you want to. I'll take my face off briefly. What you do with the wheel is there's actually two iterations of the wheel. So first, you sell the cash secure put, and then ask yourself, did it expire out of money? If yes, congratulations, you made money from that premium you sold. Go back and start over. Let's say this time it didn't expire out of the money. Is the stock above your break even? Well, yes, go ahead. Sell the 100 shares immediately. You came out ahead. You made money. Go back to step one. If not, then now you can sell covered calls at or above your break even price. And then you're just waiting for it to get expired in the money. Once it does, those shares will get called away. And congratulations, you made money. You're back here. Until it becomes until it expires in the money, you just stay in this part of the wheel until you make that money and you come out. But that's a very brief overview of the wheel. And if you're starting trading options and selling premium, like, you can research the wheel options and you'll find a lot of videos that explain it in depth how this works and why it's awesome. Final note: you have to be good at managing your risk, and this is because options is just you buying and selling risk. You have to manage it on the individual level, like the individual positions. There's risk associated with every position you put on. If you're trading more volatile stocks, that's more risky. If you're trading on stocks that trade in a range, that might be less risky than other things. Look at your portfolio as a whole. If you find yourself trading a lot of volatile stuff, maybe add some safer stocks to kind of offset that risk. If you're in a bunch of high volatile stocks, maybe use less buying power so that you can take a hit if positions move against you. Think about your risk reward. Sometimes it's just not worth it to put on a trade. Like, why am I tying up why am I tying up $50,000 on a Netflix put if the reward is only $100? So think about how much you're getting in return for taking that risk of selling that contract. Use probability of out of the money. Great thing for learning to start out with. I think ThinkOrSwim might be the only one that has that on their platform. But if you want to get an estimate of what that is, I'll go back to this options chain real quick. If you look at the delta, and this is a put position, if you take 1 and add the delta, you should get close to the probability out of the money. So here's an example of like the delta's 0.1. So $1 subtract 10 cents is about 90%. That's about what probability out of the money is. It'll give you a rough estimate. It's close enough to make a decision on. It's nice to have the actual percent so you don't have to do that little step, but it's really easy to figure out like a guesstimation of what probability out of the money would be. And all brokerages will let you put delta on. If they don't, then maybe you shouldn't be using that brokerage. The other thing I say is you should learn to read a chart. Like, it gives you so much information at a glance. You could use it to make better trades, have more confidence in your trades. A lot of contracts that you sell will immediately drop into the red, but if you know from the chart that you have a good chance of success, you'll be more capable or better prepared to ride out like the small bumps along the way until you get your win in the end. And then you really need to learn how to manage your trades. I have a video, I'll put it in the end card at the end of this video that you can click and watch. Like, there's so many ways to manage trades. Figure out what works for you. The more ways you know how to manage a trade, the more confident you'll be when you go into these positions. So be sure you learn how to manage your trades. Huge aspect of this. And with all that said, I hope you guys learned something from this video, or at least it got you interested in selling options. If you haven't joined the Discord yet, I'll put a link in the video description below. I don't know why you wouldn't. We're not selling anything in there. It's just a free server where people are, exchanging ideas and help each other learn and grow. There's people in there with decades of experience, and I'm still learning from them. Huge asset to have, and it's free. Just take a look at it. Highly recommend it. And with all that said, if you like this video, like, sub, subscribe. And I'm looking forward to see what you guys put in the comments below. I love reading those and responding to those, so please leave a comment. And until next time, I am not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.